Hey, what's up, you guys? Welcome back. So today we are going through 3 different stocks that are considered dog stocks. Now, I know what you're thinking. I know we all love dogs here, but on Wall Street, the term dog stock is not good, okay? So a stock is called a dog if it hasn't been performing well. So Wall Street really doesn't like dogs for whatever reason, which I don't get because, come on, look at this face. How could you say no to this face, okay? But yeah, anyways. Dog stocks are stocks that have been underperforming relative to their peers. And the 3 stocks I have for you guys today, there are stocks that are significantly down from their 52-week highs. And lately with the S&P 500, the NASDAQ, and the Dow Jones hitting all-time highs, these have really lagged behind. So these are underperforming significantly, and I do mean significantly because if you are one of those people, or if you know somebody who is an unfortunate soul who bought one of these stocks at their 52-week high, well then unfortunately you might be waiting a really long time before it gets back to those levels. By the way, just as a disclaimer, I'm not telling you guys to buy any of these stocks, by the way, okay? So usually there is a reason why a stock is down 50%. So please do your own research and buy these stocks at your own risk if you do end up deciding to buy them. So this is not financial advice, and yeah, don't sue me if you lose money. So with that out of the way though, let's jump in. Alright, so first on the list is Root Insurance, ticker symbol Root. So a lot of you may have heard of Root before, or you may not have. This is a company that is an insurance company. So this is not to be confused with Roots, the apparel company, which is a famous Canadian brand. Roots, the insurance company, which is the one that we're talking about today, provides car insurance to a lot of places in the United States, namely these states. And you guys can think of it as an insurance company that's more geared towards the millennial and the more tech-savvy younger crowd because they use machine learning and AI to construct a custom risk profile when you give them permission to collect information about your driving habits. If you're a safe driver, they'll be able to give you a lower quote compared to what a traditional insurance company can give you. So one of the biggest problems that I face as a driver is that I consider myself to be a really safe driver, believe it or not. So even though I am a safe driver generally and I haven't gotten any accidents or tickets lately, I am in the demographic that pays the highest insurance, i.e. Males between the age of 18 and 25. And yeah, the reason is that my fellow peers in this demographic are generally not very safe drivers, okay? So there's no way for the insurance company to know, though, who is safe and who is not so safe just by, looking at everyone like in the demographic, right? Because that's all the information they have. So what they end up doing is that they end up charging everyone in that demographic a really high rate. So what Root is trying to do is develop a customized risk profile to tailor to each person. So you would recall that this is very similar to something like a Lemonade, for example, which is also trying to get into the car insurance space, by the way. Although Lemonade started off with renters and pet insurance. So Lemonade has more kind of areas of insurance that they're focusing on versus Root is only car insurance. But let's talk about Root Insurance itself. The stock. So the stock has been being down and being down, okay? So if you just look at a chart, it's not pretty. So they IPO just last year, but the stock has fallen to $6 from its 52-week high of almost $30. So it's fallen quite a bit. And the main issue is that analysts have very low expectations for Root, with the outlook of the company being very bleak, with the company expected to decline in revenue for the current year and for the next year, and pretty significantly too. So the latest earnings report was also less than impressive, as the company posted a bigger net loss than many expected, and also their revenues were lower compared to the same quarter last year, year over year. So this is really bad for unprofitable companies to also be declining in revenue, okay? So it's okay to lose money, but as long as the revenue is increasing, then we're all good, right? But this is not what's happening here. So we're actually seeing revenues decline for Root, which is really bad news. Yeah, this is, for me personally, this is even though the stock has fallen a lot, I would want to see at least another earnings report before I feel comfortable jumping in, even at this price. So I just think that there's a lot of risk in the stock market in general right now, and this is definitely a risky stock to be in. And I do want to see signs that the company is turning around before I jump into it, before I can feel comfortable adding it to my portfolio. This is just for me personally, though. If you want to take a chance, the stock has been beaten down a lot. So yeah, you might be inclined to take a risk or maybe not. But yeah, anyways, so that's stock number one. All right, now let's move on to stock number two. So stock number two is Alibaba, ticker symbol BABA. So I don't think I have to really mention what Alibaba does. They're the biggest player in e-commerce in China, and they're commonly known as the Amazon of China. So they're actually in a lot more businesses than just e-commerce, by the way. So they have their hands in like everything, okay? So they have their hands in cloud computing, AI, machine learning, media and entertainment, financial services, among others. So yeah, the business is very diversified. And now this stock has been beat down so much, it's now near its 52-week lows, okay? So it was trading, or it is trading for $170 right now, but at its 52-week high, it was trading for over $300 per share. So it's down just about 50%. And this is one of the only major stocks that I know that is trading for below what it was trading for during the March 2020 crash. So just think about how crazy that is, okay? So there are a lot of stocks that have done a 10x since March 2020. And you're telling me that BABA is trading for less than that right now, like compared to what it was in 2020? That was crazy, right? So yeah, there must be something wrong with this company, right? Well, not really. The company has some pretty impressive growth numbers, both year over year and expected growth. So the company is now trading for a forward PE of like 17, which I don't know what sector Seeking Alpha is comparing it to, but they gave it a C grade. But that's not right, in my opinion, because I can tell you that a forward PE of 17 is ridiculously low for a company like Alibaba. So for reference, Amazon trades at a forward PE of like 50. Okay, so this has like, and Alibaba has similar growth compared to Amazon, by the way. So what's the catch then? There's got to be a catch, right? So yeah, if there was no catch, then this stock would easily be worth like 3 times what it's worth now. So the catch is that for Chinese companies, you can never really be sure what you're buying. And this is not me being like discriminatory towards Chinese companies or anything. What I mean is that there is an actual difference in ownership structure when you buy a Chinese company. And this is because the Chinese company does not allow for foreign ownership of Chinese companies. So if you're not a Chinese citizen, what you're buying is actually a shell company that is based in the Cayman Islands that supposedly has a controlling stake in the actual company. So this means when you buy Alibaba stock outside of China, you're actually buying a representation of Alibaba instead of Alibaba itself. So legally speaking, you don't actually have any ownership in the actual company. And this would involve everyone in the scheme to kind of believe that this is something that's okay, right? So as in we all agree to BABA actually, you know, representing the shares of the company, and we all pretend that it is the actual shares that we're trading. And if this trust ever breaks down, then theoretically the stock could go to zero or get delisted by American regulators, which is also another risk, by the way. So that's a huge area of concern, in my opinion. And keep in mind, by going to zero, I don't mean that Alibaba, the company itself, would go to zero. Okay, so Alibaba itself will be fine, but the stock could go to zero because it only represents Alibaba stock. It doesn't actually, like, it represents Alibaba stock, but it doesn't actually mean that you own shares in the company. That's what I mean, right? So you get how that works? Anyways, another factor that I think that a lot of people kind of were taken by surprise for was that a lot of people thought that Joe Biden would be more friendly towards China once he got into office compared to Trump, right? And then Joe Biden would like ramp down the trade war and everything like that. But at least as of right now, that hasn't really materialized. So yeah, that hasn't really been the case. So for me personally, I'm willing though to take a small risk on Alibaba, so I bought 10 shares. But for me, I'm not willing to buy any more just for the risk that I just mentioned. I think that this stock could be a quick 50% upside if things work out well. However, it could legitimately go to zero as well. Granted, I think that the chances of it going up 50% is greater than the chances of it going to zero. But my point is that you really want to limit the scenarios where you could be right and still lose all your money. So what I mean by that is that Alibaba could continue to do well, and I do think that they will continue to do well, but because of this ownership structure, your shares could go to zero if the trust in that ownership structure breaks down. Okay, so anyways, that's stock number 2. And moving on with the third and final stock we have today is Wish, or Context Logic, which is the name of the parent company that owns Wish. So this stock has been a Wall Street Bets favorite, okay? So I've seen a lot of people pour a ton of money into Wish, and people are just absolutely losing their shirts over it, okay? So this stock has just been going down and going down and falling and falling. And to be honest, guys, I know I might offend some people by saying this, but I'm really not a big fan of Wish, and I've never really liked the company itself. So if you need a reminder, by the way, of what Wish is the company where you can buy fake stuff. Or, don't shoot the messenger. I'm just conveying what the general consensus is, right? If you don't believe me, look it up. So it's fine for things like lower quality stuff like phone cases and whatnot, but it's kind of hilarious to try and buy anything remotely expensive on Wish, like an iPhone or something. So if you don't believe me, just go to YouTube and type in Wish expectation versus reality, and I think that you'll see what I mean after watching any of these like random videos. And these ads you get when you Google like Rolex watches or something like that, the ones from Wish really stands out, especially for the price, okay? So let me just say that, yeah, one of these or several of these do not fit with the rest. So my main concern is that whatever you get from Wish, it doesn't match the picture in the description, okay? So I know a lot of people, especially older folks, already don't like online shopping because you don't get to see the item beforehand, and something like Wish just makes the problem worse because when you buy something, you never know what you're gonna get, right? Or you expect the thing to look and feel a certain way, and that's not what you get when the item arrives from Wish. In fact, I feel like these days people just buy things from Wish to make fun of them, right? And compare this business model and client experience to something like an Amazon, right? Compare this to shopping on Amazon, and you'll quickly see why people prefer to buy things off of Amazon instead. So for this reason alone, I wouldn't invest in Wish no matter what the price is, because I really don't like the product and I don't like the business model. I just think that Wish contributes to the proliferation of fake items and low quality items that you're just gonna use and toss away, and it creates like this like trash problem too, right? Because like the stuff from Wish just breaks after like one use. If you're interested in this stock though, go right ahead. You can add it to your watch list, or should I say wish list. But yeah, anyways, this stock is near a 52-week low, so, some people might be interested. Anyways, so that's all the stocks I have for you guys today. Be sure to hit the like button if you enjoyed the video, and consider subscribing if you like the series. Be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye.